For those of you that don't know me, I'm Scott Talley, the founder of Network Connection. And we set out on a journey about 11 years ago to build the most efficient networking group out there. And by the grace of God, we're in about 8 countries now and thousands of members in 33 states. And we've evolved to where our goal in 2026 is to try to bring you $2,000 worth of value with each agenda. And for the last 3 or 4 months, I have been super excited about this agenda that we went through today, that we'll go through today, and hopefully what some of you went through at your monthly meeting. So we're super excited. Let me introduce Mr. Alfred White. He's a great friend of mine, a great guy, and one of the most knowledgeable people I've ever met on tax advising. So, you think of things in terms of bookkeeping, which we're going to hear from Michele a little later about tips and ways to make sure we're getting the proper bookkeeping. And then we turn these things over to our CPA, but the reality is CPAs aren't necessarily tax advisors. They're real good at making sure they get your taxes filed right. But the things I learned from Mr. White a couple of weeks ago were nothing short of amazing. So I'm gonna let him talk about the 2 books he's authored, and let me make him the spotlight. And Alfred, take it over. They want to hear from you a lot more than me. So we're glad you're here, and thank you for sharing your knowledge with us.
Thank you very much, Scott, for the warm introduction there. And basically, wanted to talk to hang on, I'm trying to advance this thing. Uh-oh. There we go. Okay. Okay, all right, everybody. I am a tax specialist, so basically I have a little over 30 years in the business as far as taxation. I do tax filing, I do audit representation, I do IRS planning, I even do settlements, IRS settlements. I am a former H&R Block franchise owner, and I have 2 published books on Amazon right now, so you can just look me up. There's a book titles, The Hidden Wealth in Your Taxes, also the 10 biggest mistakes people make on their tax returns. Why do I do this? My dad, when I was young, got audited pretty much every year by the IRS. And not only did he get audited, but he had to pay taxes. And this happened every year, ever since I've known him. And pretty much I asked him why, and he just said, well, that's just the way it is, son. But my dad
Mhm.
didn't make a whole lot of money. My father made maybe $5, $6 an hour, which is equivalent to 50, $60,000 a year today. And there was a family of 4 of us. My mom didn't work. So I said, well, what is it, the reason why you have to do this? So our talk today is we're going to lend itself to business owners, also W-2 employees, because I know some of you here actually work for different companies. And most people they overpay their taxes simply because they don't plan. So the good news for small business today is that we have a permanent QBI deduction right now. The QBI deduction is the qualified business income. So it was previously scheduled to expire this year in 2025, but because of the big beautiful bill, it's now permanent. What that actually means is that simple, if you made, for an example, let's say $100,000 in your business profit, you're now only going to be taxed on $80,000. So you get that 20%. So this is for business owners, if you notice, the sole proprietors, the LLCs. Also, we've got immediate deductions for the research and development expenses. Previously, you had to itemize that over 5 years. So now you can pretty much spread that. You don't have to spread that deduction. You can actually take it all at one time. And if you had something for last year and because it wasn't in effect, you can go back and you can amend last year's return and take it now. We've got expanded write-offs for the property and equipment. That was expanded. And basically now you can write off all your property and equipment as a business owner. You can write off from the very beginning, such as your new machinery, any buildings, any software, anything like that. And the reason why you want to do it is that I tell folks is that you want to take advantage of it now, and because let's face it, the dollar isn't going to be worth tomorrow what it is today. I mean, dollar 10 years ago was basically not as much as a dollar is right now. So get all you can now. We've got enhanced tax credits for employee benefits, and this is for an employer to offer to the employee, such as paid leave tax credit, we've got child care expense, we've got student loan repayment credits. And reason why that you want to offer this maybe as an employer to your employees, you have employees, you have good ones that maybe you want to reward that you're scared that's going to leave you to go to the competition. So you want to sweeten the pot, maybe give them a little bit more benefits or something just to keep them there as a reward. So also a lot of people have been coming and they've been asking about the 1099Ks. That's been coming up for several years because the IRS has been kind of flip-flopping back and around. And one while they said they were going to have to report anything, and this is for those people that have businesses that take like PayPal, Venmo, Cash App. And one while they were saying, hey, you got to report everything, and then it was, well, we got to report everything over $600, and then, a lot of people got to screaming and kicking, so the IRS put it on hold. So basically, they came up to the conclusion that now that you're only going to be reporting it if the user has over $20,000 in payments and over 200 transactions, that's on a yearly basis. So that's pretty much good news, and that explains a lot of it right there, is what it actually does. So bad news is that we're going to have rising borrow costs because the reason why is that the big beautiful bill, even though it helps a lot, but it's scheduled to increase the national deficit by anywhere from $3 to $4 trillion over the next decade. So this means it could lead to higher interest rates. We're not saying that it will, but it could be higher interest rates. It could make loans and lines of credit a little bit more harder and more expensive to get. We know also that there's going to be cuts to the healthcare program. They've talked about that. Medicaid is going to be cut. And one of the things is that the Affordable Care Act, or some people call it the Obamacare, then that's scheduled to, as far as the subsidies that go into it, the government subsidies are going to expire at the end of the year. So what that means is that the healthcare costs for a lot of small businesses, as well as the employees, is going to be a little tougher. It's going to be a little harder to get. It might be suggested to look into some type of group health plan. You hear them on the radio all the time, some type of pool or something like that, or maybe even join with a neighboring business or other businesses to see if you can negotiate a better rate or a lower rate. The other thing is tariffs are back in full force. So we talked about that as far as the tariffs. The Supreme Court, they did shoot down as far as the tariffs were concerned, as far as some nations were 40%, 50%. But still, the thing of it is, the president has automatically said that he's going to do 10% straight across the board. Then he came back and said, I'm going to make 15% straight across the board. So every country is going to be paying anywhere from 10 to 15% tariff. So that means that, tariff on imported goods is not going away anytime soon. So, you're going to have to look for that. The reduced funding to the Consumer Protection Agency. So the Protection Agency, what they did was they sort of protected us against predatory lending is what they did. So now with, cuts there, we're going to be subject to maybe a little bit more, scrutiny as far as the predatory lending. It's going to put businesses at a little bit greater risk of scams. Uh, the good part about it is that the big beautiful bill changes. The tax bracket that was scheduled to expire, the lower tax bracket in 2025 is now made permanent. So now we've got lower taxes straight across the board for a lot of people. The standard deduction was increased. Of course, the standard deduction increases pretty much every year. But those that are over 65, they're going to get a little bit extra bonus. They're going to get a $6,000 deduction, and if they're filing jointly, it's $12,000. And this is also in addition, even if you itemize, you still get that extra $6,000 deduction is pretty much it. So it's not $6,000 in your pocket, but it's $6,000 deduction. So that means it's $6,000 reduced against the taxes you pay. We're going to have the SALT credit. That's the state and local tax deduction. That was raised from $10,000 to $40,000. And it's for those that are single and married and they're filing joint either way. And this is good just for 4 years up until 2029. But what that one does is that it helps out a lot of people that are in the high taxation states like Texas, New Jersey, California, New York. These are states that, you pay high income tax. Texas doesn't have a state tax, but we have a high property tax here in Texas. A lot of these states, and you were limited to $10,000. So if you got your property tax, you got your sales tax, You got everything else. You were limited to $10,000. So now they've raised it. So if you're itemizing, you actually see that. So that's going to be a big bonus to help. The child tax credit, that was increased from $2,000 to $2,200 per child. And in 2026, they're going to index it for inflation. So it's possible it could go up every year just based on inflation to help out. We've also got the automobile interest deduction. Now that's great. That's for people that purchase a new car, a new personal car for passenger vehicles. And that's what it's limited to. Not and when I say a new car, it could be a truck, it could be a pickup truck or an SUV, but it's limited to the $10,000 worth of interest. Now you can take this interest pretty much off the top. The only thing of it is the vehicle has to be assembled in the United States. Now, it could be a Toyota, it could be a Hyundai because they're actually assembled here in the United States, even though they're foreign countries. But still, that's great. Okay. Another thing is that we no longer going to have the clean energy credit. That is gone. So when I say the clean energy credit, that's the solar panel credit that was on the house. So if you're going to install solar panels, also those that wanted to go out and buy the electric cars, those that upgraded their air conditionings in the house or efficiency, greater efficiency or energy efficiency appliances, those are gone. Uh, and also the Trump account was created, and this was for children that were born between this year, 2000, well, actually between 2025 and 2028. So the government's going to offer a one-time $1,000 contribution is what it's going to do. So you just ask for it when you file your taxes. You click the little button, and it automatically creates an account for that particular child. Now, it's going to be treated sort of like an IRA. We don't know all the details yet. But you can also, in July of 26, add any parent, individual can add up to $5,000 a year to that account. It's not tax deductible, but you can add that money in there every year until that child turns 18. So you imagine when a child turns 18, you probably, and it's going to gain interest. So that child will probably wind up having, I think they're saying maybe anywhere from a half a million to possibility to $250,000. But the adoption credit, now that's a great one. The adoption credit actually went up, and it went up to $17,280 is what it went up to. Now, it was 16,810. You said, okay, well, that's not too much of a deal, but it actually covers the agency fee, the court costs, it covers travel. But the good part about it is $5,000 of that is now refundable. Nothing was refundable of that back in the past. So when it says refundable, so even if you have a tax liability of zero, then you can look for $5,000 in your pocket. And if it's a special needs child, you can deduct the entire amount, the $17,280, even if you didn't have the expenses to cover it. So that's another thing right there. Because we do know a lot of times that these agencies, if it's a special needs child, they'll cover it just to get that child, and you don't have to pay anything out of pocket. So now the good part about it is you can get that $5,000. Overtime deduction. Now that's a sweet one that's been helping out a lot of people that I've been seeing. Now you can deduct up to $12,500 of overtime. Now overtime pay is time and a half only, but that's the good part about it. But it phases out if the individual made $150,000 and if they're joint 300,000. But it's a good thing to help out a good working class person. Also the tip deduction, those that are getting tips that are being reported. So now they can do the same thing. They can deduct up to $25,000. The only thing is, just like the overtime pay, you still got to pay for the Medicare and you still got to pay for the Social Security on it. But the great part about it is that there's less taxation. So if you're a small business owner, these are ways that you can lower your tax bill if you're a small business owner. Number one, just pay for your health insurance. Pay for it through your company. Number two, save for retirement. There are several gadgets out here. There's 401ks, there's simple IRAs. There's a lot of things out here that you can do to help out to save for your retirement. You claim the qualified business income. Make sure you claim that 20%. That's going to help out. Use your car for business purposes. That's a real good one there because if you're using your car, use it for business. Put it in there. Then you possibility you could depreciate it or you could write the mileage off. The IRS lets you do either one, whatever's best for you. take that home office deduction. And I know a lot of us here in business, we have our own offices. You might have your own corporate office, your office somewhere else. But if you have a business, I suggest, and and I know you have it, you have a home office. You have a desk, you have a computer at home. You come home, take work home, you do the books and things like that. To have that home office deduction, do that. And the great part about it is by having a home office, the IRS doesn't allow you to write off commute miles. So when you're leaving your house to go to your office or go to a sales call or whatever, you can't deduct the commute. But if you got a home office, you always say, I tell everybody, stop off in your home office. Hey, pull up a report, look at the internet, look at the bank account, do something. You did some work. So now you've left your home office, you go into your other office, you're going on a sales call. So now you get to write this off as what you get to do as far as your mileage. Financing costs for the business. And when I say financing costs for the business, it could be a loan, it could be a bank loan. And then some of us have businesses we don't want to get a loan or whatever. You might want to use your credit card. If you can't pay it off within 30 days, you got to pay interest. Well, then keep record of that because now you can write this off, financing costs for your business. Now, these are write-offs that specifically are for W-2 earners that don't have a business, but even if you have a business, you're still entitled to these. And these are just some of them that I've, came up with through a program. It's like oil and gas deduction, oil wells. Now, that's a good one. Who would think that you could save by, just investing in an oil well? So these are oil wells in the Odessa Permian area is where it's at, where they found a lot of the oil. And for example, if you can deduct, let's say if you had $100,000 worth of income, and the government allows you to do 90% credit, and that's off the top there. So if you had $100,000 worth of income, and you wanted to basically buy $100,000 worth of deductions into their oil wells, they give you 90%. So now you're being taxed on $10,000. The great part about it is you say, well, hey, well, why would I do this? You're investing with Shell, Chevron, Oxy, Exxon. But the great part about it is that it's not only a deduction on your taxes to save you money, but they're paying royalties as well. So last year they paid out about 24% on the average. So you get to make money on top of it. So that's a beautiful thing. Solar farm or solar equipment, that's a good one right there. That was signed off by the Biden administration. You've probably seen these solar farms in the desert, the gigantic football fields full of solar panels and everything else. So now if you can invest in this, and the IRS allows you to take your last 3 years of taxes that you've already paid. So that's the great part about it. This is money you've already given to the IRS. The IRS says you can request that money back to make an investment into a solar farm. The great part about it is what you put up, they match 100%. So when they match this at 100%, they allow you to take the depreciation. And that's a big tax savings right there. Equipment rental to the United States government. The government has warehouses. They have different things off in there. You got forklifts, you got all types of warehouse equipment. So there's an organization that allows you to buy the equipment from the bank. They tell you who to go get it from, what to buy, and everything else. But you get to lease this out to the United States government. The great part about it is now because of depreciation, bonus depreciation, you get to write the equipment off the top, off your taxes. So once again, it's a tax savings. But guess what? The government's going to pay you 15% over that bank loan. So how do you feel, man? You're getting a write-off and then you're making 15% on top of your investment. New film strategy. That's a great one. A lot of people are not even familiar with it. You can invest with a film company or certain film companies that the government allows you to write this off. And these are movies. These are movies that are made for television, for Amazon, for Netflix, things like that. So you get to be the executive producer because you put money in it. You get to write it off. The great part about it is that they only ask for 20% as far as a investment. They match you with the 80%, but they allow you once again to write off 100%. Charitable finance, these is for like Doctors Without Borders, things like that. So they have you to invest in gift cards. So you might invest, let's say $20 in a $100 gift card, but you get to write off the $100 and you donate it to charity. Convertible tax bonds, you get some of your monies back if you overpaid a certain amount that you paid over the last 3 years. The government allows you to get it back. GFX trading, that's Forex trading is what that is. And the great part about it is that's a certain write-off because the great part is if it's making money, you get to keep that money. And if it loses money, guess what? The government allows you to turn around and take this as a loss. And one of the things is I tell folks, if you don't do anything, start a home-based business. Now, these are hidden tax writers. You talk to your tax advisor about the Augusta rule. I know a lot of people have heard about the Augusta rule. So you get to lease your house out to your company for corporate events or meetings, and you get to do it for 14 days a year or less, but you just have to document the meeting is pretty much it and have a paper trail. Pay your children to work in your company. If you have a company, when you say pay your children, now the child has to be under 18 is pretty much it. When I say pay your children, because a child under 18 doesn't have to pay taxes as long as you keep them at the standard deduction or lower. And now you have to designate the child a job, is what you have to do. You have to give them some type of title. A lot of these kids are good on the internet, so they could be your marketing person or your internet person or something like that. But pay your children. And I tell folks, even if it's a newborn baby, they say, well, what can the baby do? The baby could be a model. So you create a website, put the baby on there. The baby's a model. Models get paid, right? So that's it. So board of directors quarterly meetings. Now this is great because a lot of times we want to take vacations. We want to go to different places. We want to go to Hawaii, Costa Rica, things like that. So how would you like your business to be able to write this off and pay for it at the same time? So you just have your board of directors meetings. You just have it. The IRS says you can have it anywhere you want to have it. So, hey, guess what? We want to have a family trip in Costa Rica. Everybody in the family is a board member. They might be non-voting board members, but they're board members. So we're going to have a trip to Costa Rica. We're going to have a trip to Hawaii. And guess what? The business is going to take care of it. Health savings account. Now, that's one that you can write off as far as the business is concerned. And one thing about the health savings account is you don't have to withdraw the monies at the end of the year for any type of medical purposes. You can let the money stay there. The money can actually stay there and it's actually earning interest and it's actually growing and it's growing and you don't have to pull it out until you want to. And the great part about it, I tell folks is, if you can, keep it there, let it grow. And then if you find some type of good investment, then hey, pull it out then. Invest in something. One of the investments that we just talked about. Income shift in the S corp. Now that's one. Whereas that you talk about most of us when we start a business, we don't think about corporations, but the self-employment tax is 15% on a dollar. And that's rough. So you can save some of that 15% by just switching to an S corp. Family management company, accountable plan. These are for corporations, people that actually have designated themselves as S corps or C corps. So you want to look out for for write-offs there, and just think about those two right there to talk to your person about. So these are examples of tax savings. These are people that we've been able to help in the past. So I just want to show you some examples like Paul. Paul is in sales. Now, if you notice, Paul has an income of $485,000, but he had a tax liability of 138,000 is what he had. But guess what? We were able to save Paul most of that money is what we were able to do. So now, because of what we did, Paul's tax liability is only $500. And what did we do for him? He did the accountable plan, he did the Augusta rule, and he did equipment leasing. We've got John over here in construction. John made close to $2 million is what he made close to. Now, his tax liability, $2 million is nothing to sneeze at, but he's got to give Uncle Sam close to $367,000 of that. But we were able to save John, guess what? The entire tax liability, he saved $377,000. His tax liability now is zero. What did we do for John? John did the accountable plan. He did the Augusta rule. He did the family management company. John hired his kids. That's what he wound up doing. So you can see it's all possible. You don't pay taxes unless you pretty much want to. Uh, Taxable income. Here's another one right here. Leo. Leo owes $253,000. Leo has an S corp right now, though. Leo has two kids. Leo is a homeowner. We helped Leo save over $227,000. His taxable income, as you see, was $542,000. His federal tax liability was 193. Leo was the state that had tax, so the state tax was almost $60,000. So if you combine the two, he's got a tax liability of close to $254,000. But Leo was able to save $228,000. Now he has to give Uncle Sam $17,000. Not bad. He's still paying something, but he's not paying what he was going to pay, the 193. So the state tax, he's saving a little bit on that. He's saving about 8 grand. So he gives the state 51,000. So now he's got a total tax liability of, let's say, $25,000. We're able to save Leo on the board of directors we talked about earlier. So that was a tax deduction of $14,400. But the savings to Leo was $7,878 was in his pocket. The accountable plan, we talked about that. The tax deduction was 25,000. The savings was 13,000 in his pocket. The Augusta rule, tax deduction 25,000, put another 13,000 in his pocket. The equipment lease, this was the big one. It was $400,000 deduction because of the bonus depreciation. But that saved him right there, $194,000 in Leo's pocket. So imagine what Leo could do now. Hey, guess what? I was about to give this money to the IRS, and hey, now I guess I get to keep this money. So, just think about what you can do for yourself or your family. So what we do is we actually guarantee what we do because the tax law is complex. We know that tax law always changes. And we promise we can do everything legally possible. We want to keep your money working for you. Because remember, that's what I said. I want to keep your money in your pocket. I want to keep it away from the IRS. So we guarantee that by executing one of our tax plans, we'll reduce your tax liability by no less than $10,000. And when I say $10,000, we're talking about $10,000 in your pocket is what we're actually talking about. And that's provided that the strategies are carried out as we tell you to do them, and the assumptions that we put Elf into the computer, they remain unchanged. Now, what I'm willing to do, because we're here, is I'm willing to offer you a no-cost tax assessment plan. This is a $2,497 value is what this is. Normally, I charge $2,497. You say $2,500, but guess what? If I didn't save you the $10,000, I wouldn't charge you. Okay, but in this situation, I'm going to go ahead and offer it to the NIA members at no cost. The only thing I want is you provide me with a Google review or a nice testimony. If you want to schedule a consultation, that's my QR code right there. You just take a picture of my QR code and just get a hold to me. It goes directly to my website. Put your information in, and I'll be back in contact with you to help you save some money. And the whole goal is that, like we said, they always say it's not what you save, but it's what you keep. So, you want to keep as much money as you can in your pocket. And thank you very much for your time. I don't know if anybody has any questions for me, but
Yeah, let's open it up to questions. Anybody have any questions of Alfred?
I actually have a question. Hey, this is Michele. So, Alfred, on the conversation you were having about paying for employees' childcare and things like that, is that income on their W-2?
That is not income on the W-2. That is
Interesting.
simply a business write-off, but that is not income on the W-2.
So you pay directly to the childcare or you pay the employee?
What you do is you pay the employee, but you list it on the W-2 as a line item as childcare. And what you do is you list it as childcare. That means that they can't double dip. They can't write it off themselves because the business actually paid for it.
Okay. All right. That's all. Awesome.
I have a question.
Mitch.
Alfred, great presentation again this afternoon. I'm interested in doing the Augusta rule this year. And you mentioned that you really have to have, great paper trail. So like for 14 days, if I have a meeting a day, is that the best way to, make sure that I'm covered on any conversations or
You can have a meeting a day, Moose, or when you got 12 months in a year, you can have a meeting once a month. Now, when I say 14 days, the maximum you can do is 14 days, period. And reason why it's 14 days is because there's a question if you ever look at your taxes, they want to know if you rented your house out or rented the property out for more than 14 days or less than 14 days. If it's 14 days or less, then you don't have to declare it as income unless you want to. But then why would you? Because you're going to be taxed on it. So you can do it once a day. You can do it, and by the paper trail is that you want to document the meeting, the minutes of the meeting, who was there at the meeting, what was discussed, and things like that. That's the paper.
Let me add, Alfred, it's super easy to find out like what your house would rent for. You can go to VRBO or Airbnb, look for a like-sized house in your area.
Right.
Let's say it rents for $750 a night. But I've won a lot of money, Alfred, betting people, not money, but I'll bet people a cold beer. For years, I've asked people about, I bet I know something about the tax code you don't know, and I'll mention you ever heard of the Augusta rule? I would get really familiar with it because it's a really easy way to save some tax dollars.
And another thing too, Scott, you don't necessarily now VRB is a good one, but there's another thing you can do. You can actually call one of the local hotels. So you can call a hotel in your area and say, "Hey, I'm thinking about having a meeting for 15 people." And they're going to ask you, of course, how long. I want to rent a room or facility or something like that. I want to rent your hotel out for a room for 15 people. But I also need you to provide food or coffee or drinks or whatever you're planning on doing. And how much is that going to cost me? So then you want to use that figure because that figure is probably going to be higher than the Airbnb, the VRB.
Great idea. Great idea. Good. Thank you.
Thank you.
Any other questions before we move to Michele? Thank you, Alfred. Such a great job. It's funny. They say you learn how to make money in your 30s, you learn how to keep it in your 40s. But every time I hear you talk, I learn a little bit more, and I'm certainly way beyond 40. Let me introduce you to a serial entrepreneur who knows how it feels to fail miserably in business, and I love that because we always talk about our victories. At one time, she owed the bank, they were demanding their $1.5 million back. But she also knows what it's like to sell a business for over $9 million. Michele is my personal bookkeeper. Michele Feist is driven, decisive. She doesn't pull any punches, and she's newly married. So welcome, Michele. Thank you for sharing your knowledge with us. I'll let you take over the screen there.
Awesome. Thank you. So I can share. Let me see if it'll allow me to get on here.
There you go. Yep.
Very good. So you guys see my
it's coming up. Yes, ma'am.
My screen now. Awesome. Yep. So we're going to deep dive into some numbers conversations today. I'm going to tell you a little bit about me, but before I do, let me say this. If you would like, I'm going to walk you through this conversation of looking at where you are in the world of finance for your business. If you want, you can go to bottomlinefocus.com/reality-check. Okay. You don't have to, because I'm literally going to walk you through it on the screen. But if you want it, you can go there and download this stuff that we're going to be talking about. So I'll give you a few minutes to work on that if you want to. In the meantime, thanks, Scott, for introducing me and inviting me. And let me just, some of you I know, I was looking at who's on here, and that's exciting to see a few of you, but a lot of you I don't know. So let me tell you a little bit about me. I am, as Scott said, I am a serial entrepreneur, and I am a lifelong entrepreneur. I like to tell people that I was born into a family that had kids to guarantee they had employees. We had a grocery store, a mobile home park, a record service. My dad started our trucking company when I was 7. So literally, since I could stand up straight, I could work, right? And as Scott was talking about in my introduction, in that trucking company in the late 80s, I don't know if you guys, I'm kind of dating myself here, but if you remember what was happening in the 80s, I am in Louisiana, I live in Louisiana, and the oil field had crashed. And so the whole industry was down, and we were an oil field trucking company. And on top of that, interest rates were in excess of 18%. People complain today about interest rates. They weren't doing business back in the late 80s. And so, I'm in the office. I pick up the phone one day and I hear the banker say, "Hey, Michele, you and your dad in your office? I'm going to come by." Which, your heart starts to palpitate because the banker doesn't just make fun visits usually whenever things are in trouble. So he comes by, and I'll never forget this. He said, "It's not me, but my boss thinks that you..." Uh-oh, did I lose you? Are you there?
Yeah, you're good. You're good.
I'm good. Okay. All of a sudden, I got that internet conversation going on over here. Anyway, the banker says, "It's not me, guys, but my boss thinks that you do not have a viable company. So we need our money back. $1.5 million in 1989. A lot of money." So I won't tell you the whole story, but I will tell you in 2007, when we sold that particular company for $9 million, it was a lot of work to go from the banker calling the loans to actually rebuilding it and building it into something that's sold. And so that's kind of the start of my story that gets me to what I do today. Because in 2007, we sold the trucking, we sold the grocery store. I retired. I was 42 years old. And then I'm like, well, what am I going to do next? Right? The kids are still in school and I needed something to do. And so I did a few things, but I started a business consulting business. I loved it. I was helping small business owners do what we did, which was if they want to sell, great. People do come to me because they want to prepare their company to sell. However, how do you build a business that is, gives you the lifestyle that you want, right? The reason you got into business in the first place. And that's what we did very well as business owners, as a family. And so along the journey of that, the frustration I had as a business coach was that my clients never had good financials. They either didn't have them at all, or they'd hand me their balance sheet and I'm like, liabilities should not be negative. This is not accurate. How do you build a business from non-accurate numbers? So that was kind of that thing in the sand in 2020 when I said, that's it. I'm doing your bookkeeping or you can't be my client anymore. And so that's when Bottom Line Bookkeeping Solutions was birthed. And now that's it's flipped on its head. Now that is my approach. I do everything from the numbers side to help you build businesses. So we're going to do two things today. First, we're going to look at this little questionnaire. And yes, you're going to kind of grade yourself on where you fall in this questionnaire. So if you didn't download it, no problem. Get you a little piece of paper and a pen. And I'm going to ask you some questions. You're simply going to say yes or no. That's it. It's 20 questions, yes or no. And by the way, if you're not sure, that's a no. Okay, because yes is easy. Anything else is no. Okay, and then at the end of that, we'll count those yeses, and I'll tell you what that means. So let's just jump in and get started. So let's start with financial clarity. Okay, remember, yes or no. You don't need to write down the questions, by the way. Just write yes or no, and we'll count them at the end. I know my exact monthly profit, not just your revenue. A lot of times when I talk to people about businesses, they know their revenues. What they don't know is how much money they're making, what their profit is, what's that bottom line. The next question, my books are updated within the last 30 days. Okay. Next question, I can explain the difference between profit and cash flow. This is actually really huge, right? I'm not going to tell you the answer yet, but after a while, I'll answer it if you want me to. I can explain the balance sheet versus the income statement. Yes or no? I review my financials at least once per month. Ooh, did your heart just start palpitating? It's all good. We're all good. Okay, next questions. And these are our record keeping discipline questions. All business expenses are categorized correctly. I should say on our P&L, right? Next one, I never mix personal and business expenses. Next is I reconcile my bank accounts every month. And by the way, if you don't reconcile them, yay, you have someone who does reconcile them, would also get you a yes. Next question, I know which subscriptions I pay for and why. I will tell you, I find so much wasted money in my clients' accounts because of subscriptions these days. It's too easy to miss those. Next question, I could hand my books to an auditor without panic. Oh, it's another one of those heart palpitation questions. Okay. All right. How are we doing? Let's move on. Tax and risk awareness. I know how much I should be setting aside for taxes. I'll put a little plug here. If you don't, you need to call Alfred. Next question. I could survive a tax audit with my current records. Then I understand which expenses are deductible versus risky, right? We have to learn our what risk we can take as a person. Following question, my payroll taxes and sales taxes are filed on time and accurately. Then the next question, my accountant does not have to fix my books every year, right? I'm hoping that gone are the days, and I know Alfred probably hopes the same thing. Gone are the days when you're bringing in a box of receipts, right? We have great ways to not have to be that business owner anymore. One more slide on these, and then we're going to count our scores. These are the strategic insights. So I know my most profitable products and/or services. I know my least profitable products and/or services. I know my cost to acquire a customer. And I'll say I did part of this presentation a couple of weeks ago at the Houston NIA for Scott, and that right there became a huge part of our conversation, right? Understanding the cost to acquire a customer and why that's important. I know how much runway my cash gives me. What that means, if you're not sure, is how much cash do I have, and how long can I live paying my bills, my expenses, my business expenses on those. So do you have 3 months of cash in the bank? Do you have 6 months of cash in the bank? Do you have a week of cash in the bank, right? And then the last question, my numbers help me make decisions, not just file taxes. That's huge. And that's really where we're going to focus today, is how do you use the numbers in your business to really build a profitable business? Okay, so now it's time to count. There's a total of 20 questions. So we're only looking for the yeses. I want you to count your yeses, and then let's see where you fall, right? So 0 to 5, you're kind of in that financial foundation zone. It's time to get started on creating some good, solid foundational systems for your business. 6 to 15, that's kind of that emotional accounting. I wake up every morning, I check my banking account. If I got some money in there, I can keep going, right? I can pay that bill because I got money in there. 11 to 15 might be running still a little blind, but it's recoverable. Like you've got some systems in place. It's still tight. It's still a little tough. And there's ways to grow and to move, but doing well. And then 16 to 20, you're sitting in that CFO mindset. Okay. Anybody want to talk about what they got before we move on? And sometimes that's something, and sometimes there's not here. Let's see. Can I see you guys? Anybody? Okay, I'm good. Fantastic. Okay, so what I put together here for you is kind of what I call the 5-minute financial review. Okay, what can you be doing as a small business owner or business owner, or maybe you are the COO, or somebody that's helping to run the business. What is it that you can be looking for where you can see those red flags that give us information and help us to run our businesses better? And so we're going to talk about 5 different things. And most of those 5, pretty much all of them, are coming from a couple of reports. So this is what I want you to run whenever you are starting this conversation. You're going to pull your P&L, right? You want to look at year to date. You want to look at the current month. We're sitting towards the end of February. If you have a bookkeeper, surely January is closed. We should have seen that closed by the 10th or the 15th, depending on what type of bookkeeping you have. And what are we doing? What's going on in this month? We don't necessarily want to wait 3 months to find out what our numbers were so that we can make business decisions, right? How are we making these business decisions? The second report that's important is the balance sheet. Okay, you're going to pull that as of month end. So what did it look like at the end of January? Optional, but very helpful. And these will come up in some of these conversations. And that is your accounts receivable aging and your accounts payable aging. Okay, so when should you do this? I will tell you, I like for my clients to have weekly financial conversations with their team, whoever it is that's helping them. Maybe you're having this meeting with your spouse or your bookkeeper, right? But we want you to get to a point where you're looking at your numbers on a very regular basis. Fabulous. Okay, so number 1, and these are the types of, these are things we're looking for so that we're sure that not only are we running a good business, but our financials are accurate and we're making decisions from information that's good, right? So number one, your profit looks good, but the cash feels tight. People say that to me often. Hey, why does my P&L look like I'm making money, but I don't feel like it? I don't feel it. It's not my bank account, right? So what do you do if you have these feelings? So you're going to compare the net profit on your P&L to your bank balances, right? So where are your bank balances? They're on your balance sheet. You're going to see your checking accounts and your savings accounts and your money markets and all those types of things. So whatever the cash is, it's going to be at the top of the balance sheet if you haven't looked at your balance sheet in a while. Okay, it's in the very top, which is where your assets are. So what are the red flags? Profit is up, but the checking account is down. You're borrowing to make payroll even when you have a quote good profit, right? The bookkeeper's saying, hey, everything looks good, but why am I not able to make payroll? So the likely causes of this are usually an AR, right? You're not collecting your AR soon enough, which could mean that you're not billing quick enough. I have a lot of clients in the construction world, and the way that their billing rolls out is kind of crazy. You might be billing after the fact for work, and then the client takes 30 to 45 days to pay for it. So now you've funded the entire project and you're getting paid after the fact. So we really want to look at how AR is working and what AR is sitting out there that just hasn't been collected, right? Your materials expenses, as I just said, are paid before you get paid. Debt payments. So when we look at a P&L, we don't see principal payments for loans on a P&L, right? So maybe I'll just make up. So maybe your company has $1 million in sales and you're seeing $700,000 in expenses. So it looks like you made $300,000, but you have almost nothing in the bank. And if you go look at your balance sheet, you've got equipment notes and car notes and all those types of things that are being paid, right? But those things aren't recorded on the P&L because they affect the balance sheet. So that's a cash flow issue. Owner's draw, okay, or tax payments. So a lot of times I see where owners are just taking money just because they need money. There's not a strategic plan. I will tell you, besides everything that I do with this, I own a couple of other family businesses. And one of those businesses, we lease chemical trailers to the chemical industry. So trailers, 407 stainless trailers that you see driving down the interstate behind a truck on the interstate hauling chemicals. I have a company that leases those trailers out. And I own it with my brother and my sister. And so we have a structured owner's draw, right? The rules are set. We know exactly when it's going to happen. We don't know how much it's going to be because it's based on meeting certain criteria each quarter, but we know it's happening quarterly. We know how much has to be left in the account. All of those things are very structured. A lot of times business owners they don't have a structured owner's draw. And so that begins to affect cash flow because maybe you take that money out thinking, oh, more money is going to come in before that next bill is due. And then all of a sudden you find out you've got a cash flow situation. Okay. So that is number one. Number two, revenue doesn't match reality. So what do I mean by that? You're going to look at, whether your income feels right. That's really the first thing to know. As the business owner, and a lot of you possibly are the salesperson, you know a lot about your business. You know what's seasonal and when those seasons are. Okay. So the red flags to be looking for, and we're looking at the P&L for this, and we're looking at the top of the P&L, which is where your income is. And you can run P&L reports by month. So you can say, hey, I want to see last year 12 months. So January to December, and it shows you the ups and the downs and all of that. So is the revenue strangely flat or identical month to month? That doesn't seem normal for very few. There are business structures that work that way, but very few. Okay. Maybe you had a big month that didn't show up, or a slow month looks unusually high, right? What are those? Those are the red flags. It just doesn't look right. Okay. The likely causes of this are missing invoices. And so we might have We might have invoices completely missing. I've experienced that before where the client didn't even get billed. You could have deposits that are not recorded. So if you're on a cash basis and your income is showing up when the cash comes in the bank account, and possibly that's not been recorded, that would also, if you see that, you're going to say, is my checking account being reconciled, right? Because if it's not, you might have these issues. Your revenue could be posted to the wrong account, and then you could have timing issues. Okay, so again, we're looking for these red flags so that we can get good. Really, what I desire from my clients is to be able to look at a 12-month P&L to see our fluctuations in income, our fluctuations in profitability. We're looking to see what's profitable and what's not profitable, but also I want it to be clean. I want it to be clean for 2 or 3 years, because I also want to be able to say, okay, in 2025, this is what I saw. In 2024, look at where we were. We can start to predict when we see cash flow issues coming, right? Those types of things. So very good. Okay, number 3, accounts receivable is high or it never changes. So you're going to be looking at the balance sheet on this. You're also going to look at your A&R aging. If you're using QuickBooks, my favorite AR report for QuickBooks is called the Open Invoices report. And what it gives you is it gives you a detail of all clients that show open invoices on QuickBooks. Now, you might have a client that shows that they don't owe you anything, and you run your open AR and you see that they've got an invoice sitting there. Maybe there's a payment that didn't get applied, and so they have a zero balance, but they're still showing up on the report. So this is really the report that you can pull where you can actually start to clean up your receivables. So your red flags are to look at, is your AR more than 30 to 45 days of sales, right? For if you're a service business and you collect most money within a 45-day period, is your AR much larger than that? That's a red flag, okay? Do you have old invoices sitting in the 60, 90, or 120-day columns if you're running the AR aging report, and it's column by age of AR? Is your AR balance the same every month? That shouldn't be most of the time, right? Are there exceptions to every rule? Absolutely. But that is another one of those red flags that I'm looking for if I'm analyzing financials from a CFO level, right? So the likely causes, payments not applied to your receivables. There could be duplicate invoices. A lot of times there are certain industries where we're doing estimates in the software. We're then converting to invoices. I've seen those invoices, a second invoice gets created because they didn't realize they converted the first one. And now all of a sudden we've got inflated income, receivables are off, it gets crazy. Old balances that are never cleaned up. That's what I was talking about a few minutes ago. And then again, customers paying late. So we want to begin to recognize those, how long it takes us to collect our money. If we have cash flow issues where things are really tight and we look at our AR and it is taking us 50 to 60 days to collect our money, what if we can put together a plan? Somebody actually, like, we physically mail a statement these days. That never happens anymore, right? But what if you do something like that? Or you put somebody on the phone and they're going to call people the day after you invoice and say, hey, just checking in. Did you get your invoice? Just to kind of keep the awareness. And we can, what if that drops our ARs from that 45 to 60-day window down to 35 days? You just picked up 10 days where that cash is going to be in your checking account 10 days earlier. That's how we fix cash flow scenarios. Okay, it's one of them anyway. Awesome. Number 4, let's look at the time. We're doing good. Number 4, mystery money categories are big. What do I mean by mystery money? This is actually on your P&L. We're going to look for these accounts and see if the numbers are there. First of all, if I see accounts like uncategorized, ask my accountant, or miscellaneous, right? Those accounts, in my practice as a bookkeeper and a CFO, we may put stuff there because we need to ask a client a question, but it is coming out of there before it goes to the tax person, right? There's no reason for anything to be left there. So if you start seeing big numbers in those accounts, ask questions. What is this? Why is it in here? Where does it need to go? Okay. We're going to look at owner draw and owner pay mixed into expenses. So, when I do financial reviews with a client and we're opening the P&L, we are clicking through these expenses. We're looking for things that are in the wrong place. And a lot of times what we might find is maybe the owner put in some money and that accidentally got put to income instead of owner investment. Or the owner took a draw and it goes into subcontractor expense instead of going to owner draw. Completely messes with our P&L. Okay. We want to look and see our mills, supplies, repairs, subcontractors, are they unusually high? In this day and age, we have a lot of businesses where these numbers are going to be high, but we should know what those levels are. And if it's excessive, why is it? What have we put in there? Okay. So the red flag is that any of these categories are big dollars, or we see them increasing fast, right? And do we have a reason? Do we know what's going on? Is travel super high? Well, maybe, as Alfred was telling us earlier, maybe you just went on your trip for your quarterly business meeting. Okay, we know expenses are going to be, travel expenses going to be high for that. Okay, or our business, our planning meeting expense. So the likely causes are miscategorized transactions, personal expenses mixed in, missing vendor detail, okay, poor bank feed rules. So if you're using a program like QuickBooks or Xero or any of those, hopefully you are using the bank feed to have the bank actually pull in your content into, or QuickBooks pull your content from the bank for you. And you can set up rules that tell the bank feed what to do with the majority of those transactions. And if those rules are not set up accurately, you will see a messed up P&L. Okay. And then one more, number 5, and that is that our balance sheet numbers look weird. So the things that we're going to watch for on the balance sheet, and actually I referred to this in the beginning because this is one of the main reasons I even have my bookkeeping company today, and that is negative liabilities. I cannot tell you how many times I start working with a client and I immediately see negative liability accounts. Okay, so that would be your payroll liabilities, or maybe loans, anything that's sitting there. Maybe your assets are negative. We don't want that either, right? So credit cards showing a positive number, which means that things are often recorded backwards. Loan balances that don't go down, or maybe they're dropping too fast because the entire amount is being recorded to the balance sheet instead of your interest going to the P&L. We want to be sure that when we are recording loan payments, that we're splitting out the principal and interest, because that interest is tax deductible, right? The principal is a conversation of depreciation. Equity looks random or jumps a lot month to month. And equity is where your owner's draw, your owner advances, your owner investments, those types of things are sitting. So if we're seeing very wide swings in that, then we need to look at what is going in and out of those accounts. So the likely causes are payments recorded incorrectly, loans booked as income or expenses. That's another, actually, a lot of times I will see, maybe I have a lot of clients who utilize programs like Square or Stripe or things like that to run their credit cards. And maybe they'll get a loan from Square or Stripe, to just a loan to use in their business. And I'll notice that those loans were recorded to income instead of a liability. We don't want to pay income. We don't want to pay taxes on loan amounts. So if they get recorded to income, that's a problem. Journal entries used kind of like Band-Aids. If just don't know what to do with it, so I'm going to create a journal entry and just put it here. And that usually causes issues. And then reconciliation issues. So I know I threw a lot at you guys really fast. A lot of things I want you to be kind of, just aware of when you're running your business and looking at your financials. I want you to be at a point where you feel confident in what you're looking at and what those things mean. So remember that profit is a number. Cash flow is a system, right? Cash flow is what we have to be focused on. Yes, we want to make a big profit, but if you fix your cash flow, profit comes with it. Okay. So clean books equal confident decisions, good reports, better. That means you can price better. You can plan your business better. You get to sleep at night because you know that your numbers are right. And I say it all the time. There is never a better time to start than right now. So if you felt your gut wrench 2 or more times in this conversation, then maybe we need to have a conversation. So I put my cell phone number there. You can text me and say, hey, let's talk. Also, you can just go straight to my calendar, bottomlinefocus.com/connect. And Scott, I will open it up for questions if
Please.
anybody wants to
Any
talk about
questions of
something.
Michele? It's not the sexiest topic in the world, but it's not anything more important, I don't think, than having this first part right if you're going to own a business. Any questions? Okay, well, could give a personal testimony. Michelle's been doing my books for a good 4 years now, and I have slept better every single night, every single week, and every single month since this is my weakness. So thank you, Michele, for sharing your expertise. I want to give a quick other shout out. Would you believe that Michele probably drives further to Network in Action than any member in the world? She comes 2 hours and 10 minutes every single month. She's always on time. She always attends, except when she's in the middle of a honeymoon, Alfred. Other than that, she's been there consistently. So I love that story. And I know she's had a lot of input and a lot of help she's given Network in Action members, and hopefully that comes back to her in spades. So thank you all for joining us. I appreciate each and every one of you in your time. Special thanks to Alfred White and Michele Feist.